We interrupt to bring you this breaking news story. Enron, one of the world's largest energy giants, located in Houston, Texas, has declared bankruptcy today. It is believed that Enron has been fraudulently reporting its financial position for some time now, and its accounting firm, one of the largest 5 audit and accountancy firms here in the U.S., Arthur Andersen, is heavily involved. The bankruptcy is the largest in American history, leaving thousands unemployed and investors empty-handed. We will bring you more details as they are uncovered. Stay tuned for this top news story. It is a sad day. As you can see, the mass exodus of Enron employees leaving the building. They have packed up their belongings in cardboard boxes and are leaving Enron for the last time. They are distraught and in disbelief at their current jobless position. What happened, you may ask? Enron's leadership fooled regulators with fake holdings and off-the-books accounting practices. Enron used what is called special purpose entities to hide its mountains of debt and toxic assets from investors and creditors. The price of Enron shares went from $90.75 at its peak down to 26 cents the day before they declared bankruptcy, December 2nd, 2001. Billions of dollars were lost because of this fraudulent behavior. But over the last several years, from 2004 to 2011, the company has paid its creditors more than $21.7 billion. Again, this pales in comparison to the billions of dollars of loss created by their fraudulent reporting. So here's how it works. Enron needed money, so they created these special purpose vehicles, or fictitious companies, if you will, so they could borrow money on their behalf. Poof, right out of thin air, they created them. The SPV then contacted the bank and said, "I need a loan." The bank said, "Sure, no problem." Of course, the SPV can't pay the loan back because they're not a real company. But then Enron goes, what SPV? As a result of this bankruptcy, Congress began to act quickly to create an act to protect investors by improving the accuracy and reliability of corporate disclosures made pursuant to the security laws and for other purposes. 2 congressmen, Senator Paul Sarbanes and Representative Michael G. Oxley, were co-sponsors of what is now known as the Sarbanes-Oxley Act of 2002, or SOX for short. Major provisions of SOX include the creation of the Public Company Accounting Oversight Board, which has the authority to establish standards related to auditing, internal controls, ethics, and independence, and any activity relating to the preparation of audited financial reports. The Act also now holds corporate executives accountable, and they must verify the financial statements and disclosures are accurate. Auditors may no longer perform certain non-audit services, such as investment advising for their clients, and auditors are required to maintain all work papers for 7 years. Additional provisions include auditors rotating off of a particular audit within 5 years. Conflicts of interest are now prohibited, meaning that audit firms are not allowed to audit public companies whose CEO worked for the audit firm and participated in that company's audit during the preceding year. Hiring of auditors must be done by the audit committee of the board of directors and not company's management. And last, but certainly not least, internal control. Section 404 of this act requires that companies' management document and assess the effectiveness of all internal control procedures, and the auditors must verify that management's assessment is fairly stated. Hopefully, we can learn from the past and not repeat the same mistakes. Ethics is part of accounting. Remember, you can always make more money in this profession doing things the right way than you ever will the wrong way. We hope you've enjoyed this presentation on the Sarbanes-Oxley Act of 2002. For more information, please stay tuned for your next video on internal controls.